Great. Thank you very much, everyone, for coming. I'm delighted to be here. So my colleague and I, last time we were in Malta was back in February 2019. So that was 3 years ago. Time flies, and we're very fortunate to be able to come back here. We wish to have got back here in 2020. Obviously, it wasn't possible. So since I've seen so many faces tonight, we would definitely want to come back here more often, hopefully from here. So what I've got for tonight, if I have prepped something about how we have evolved over the last 5 years and what we are thinking about in the next 5 years. I don't know if many of you have followed what we do at Blue Whale and just to cover a few things that I thought is just worth to have a bit of recap in terms of what we do, how we go about investing, our approach, and then I will go into the topic that I prepared today. So at Blue Whale, we run a high conviction portfolio of about 25 to 35 companies. So on average, we invest into about 25 companies. You would have got a fact sheet in the back that shows you the top 10 holdings in the fund, which account for about 50% of the fund. So this is a very high conviction portfolio. And the way that we go about this is we invest into high quality businesses at an attractive valuation. This is the investment philosophy. How do we go about this? There are 5 of us on the investment team. And given that we only on average invest into about 25 companies, it means that there's quite a lot of time on our hands to do research on our companies. So you just imagine that when you have 5 people covering about 25 companies, which is about 5 companies each for the entire year, then you can imagine that the time that we spend on every company would be a lot more than some other funds that might have lesser people on the investment team, or if they invest into more stocks with the same number of teams, so that they ended up spending less time compared to us. And how we go about this is we do all the research in-house. So we go through all the primary sources that we can get our hands on in terms of data, reports. We go through annual reports of companies. We look at transcripts of conferences. We look at annual reports of the competitors. And after we've done all the research, then we translate our understanding into a financial model. So I don't know if any one of you are familiar with what a financial model is. It's basically forecasting how much money this company would make in the next couple of years based on what they have done in the past. And of course, what they have done in the past will be quite different in terms of where they're heading in the next couple of years. So you want to make the financial model quite robust to factor in different assumptions, the different dynamics that is going to take place, maybe certain headwinds they might be facing depending on what sector you are in, or certain tailwinds that they might be benefiting in the next couple of years. And then we make forecasts in terms of how much money the company would make, and then we would then factor in the valuation part, which we look at free cash flow yield adjusted for debt. Okay, maybe it sounds a bit techy, but it's basically looking at how much free cash flow the company would have got after a year based on all the expenses and everything that they need to invest back into the business. And we look at that over the medium term. So that is the evaluation approach. And at any one point in time, we want to pick the best 25 companies that we can find in our universe. We cover roughly about 100 companies, and constantly we want to look at new ideas, which I think this year we have got a few more that I will share with you later. And we continue to evolve this process. So the process being 25 stocks, we cover about 100 companies, continue to do research, we track the quarterly earnings quite closely, etc. So this is like a quarterly rolling cycle. And hopefully, so after all this, hopefully that at any one point in time, we will be able to present you with the best portfolio of high quality businesses that we believe in that would do well in the next couple of years. So we try to constantly make the portfolio fresh in that perspective. But how do we go about defining high quality businesses? So I have prepped a few pointers here, which I'm going to illustrate through a few examples later on, just So maybe just remember what I've got on this slide, and later on it would make more sense when I put this in context in terms of companies that we actually have in the fund. So the first and foremost that we look at return on invested capital profile of a company is basically how much money they make for investors, like the shareholders, over a long period of time, and also what we expect them to do in the next couple of years. But of course, it sounds quite simple, and there are many ways of going about this. Some people would have done some quantitative screening. You can look at historical, I want to look at a list of companies that would have generated very high return on invested capital in the last 10 years, and I want to invest into those companies. I think that's part of the answer, because the real challenge is what these companies are going to do in the next 5 to 10 years. It's not what they have done in the last 5 to 10 years. If suddenly there's a new competitors coming in, if their business model is being disrupted, if their product that they're selling become a legacy and there's a new product which is much better, then the business model get disrupted. Then it means that in the next 5 to 10 years, the return on invested capital profile will be a lot lower, which you want to avoid those companies. You basically want to invest into a company that already have high return on invested capital profile, at the same time is growing or improving, or at least is status quo, that is not deteriorating. And there are a few ways to go about thinking about this. Is one of those is looking at the competitor landscape. So depending on whether this company is already a market leader, whether they have a monopoly status in terms of the market they are in. And then the other one to look at is switching costs. So one thing that I've talked about quite a lot, especially during the pandemic, is we never consider Netflix as a high quality business. But of course, when you look at the share price during the pandemic, it's done extremely well. The reason we said it's not a high quality business, not only that the contents that they pay for, that for example, they recently released The Crown, which is very good, I've watched it, is very expensive to produce such a drama. And at the same time, they do have a lot of competitors, like in the US would be Disney Plus, HBO's, in the UK with Now TV, and then we have YouTube, we have Amazon Prime, and there's many others. But then the other thing to consider, whether a company is high quality or not, is about the switching costs. So if you're selling a product and services that you can lock in your customers, which means that the switching cost is very high, not very low, then it's likely that it's a good business, because you can't get out from that ecosystem. You continue to pay them a very high level of subscription fees or the product. But then for Netflix, is what we know is the switching cost is quite low. You can easily just have finished your Crown episode and then you turn it off your subscription for 3 months. And then you use your money, the €15 per month, to go onto somewhere else to watch for 3 months. And then you come back to Netflix 3 months or 6 months later. There's many alternatives. So what it means is, even though Netflix has a subscription model that you would think is high quality, because it's better to have a subscription model, but at the same time that because of the competitor landscape, that they're not a monopoly, it's not the only option if we want to consume content, then switching cost is very low, which makes them low quality. So for them to deliver a high level invested capital is very difficult because of these two factors. As soon as they start to raise prices, then we might want to consider, or we might want to share lock-in, and there's many things that people would do, which is understandable. And then the other few things which I got at the bottom, which I would touch on more when I go through some companies, is we want to see companies that can grow in the next couple of years. We want to see them to take a bigger share of the world GDP. So hopefully they would have some sort of structural growth drivers, which is independent of the world GDP growth. So if you think about the world GDP growth, it's about maybe 3% on average. That there's many businesses that would be a GDP plus business, which means that they would grow maybe 3% on top of the world GDP. But if the world GDP is not growing, then they would grow about 3% rather than 6%. That is kind of not the businesses that we are after. What we want to see is some sort of transition or transformation. And when we first started, that there are many digital transformation opportunity that we were looking at the time and also invested. And one example would be Adobe. If people are familiar with the product Photoshop, or if you have edited some video online, created some content, it's likely that you will be an Adobe customer, and they do own about about 75% of the market. So most of the creative professional would have used some sort of Adobe product. And when we started the fund in 2017, most of Adobe's business was still not done on a subscription. So if you remember many years ago, I think some people might not, is we would be updating our software through a printed CD that we put onto our computer, on our CD-ROM or DVD-ROM, and then we would spend a few €100 to buy that version of Adobe Photoshop, we put it onto the PC, and then it get refreshed. And then we don't need to spend any more money for the next few years. And then a few years later, Adobe came out with a new version, similar to any other software businesses. And then we spend a few €100. That's how we do it. But since 2014 and 15, they started this transition, which is based on subscription, that now the transition has been completed, like not 100% or close to 100% of the user of Adobe product would be paying about $20 a month. You keep paying it, and if you stop paying it for a month, like Netflix scenario that say, I want to take a break, that is fine, but then you do not have access to the Adobe software anymore. So basically you can't get back to your software if you want to say, I want to edit some photos after I've gone on holidays, but then I have not been paying Adobe £25 that month. You would not have access to that program. So for Adobe, it's just a very different end market that if you are creative professional, that this is a service that you constantly use. So then in terms of the transition to get people onto the ecosystem, that it makes the business a lot more high quality. And also when they raise prices, you're stuck. Like you can't just say, why don't I wait for another year to upgrade my software? Like the price increases would happen straight away, that next month you were just paying a bit higher, more to Adobe. And then the last 2 points is obviously we want company to have a strong balance sheet. And this year is particularly important looking forward to the next couple of years, is you don't want to, most of the time you don't want to invest into company that have an indebted balance sheet, because whatever they are paying in terms of interest rate in the last couple of years, in the next couple of years, if they need to refinance their debt, they are going to pay a much higher level of interest rate. And of course, servicing your debt would impact your free cash flow that we talked about before. So that would make the return profile of the company to be less attractive compared to before. Most of the company that we have in the fund, the Blue Whale Growth Fund, they are net cash. So most of the names that you see on our top 10 on the sheet there, like Microsoft, Nvidia, and many other names, they are net cash on the balance sheet. So you can expect that not only that they do not need to pay a high level of interest servicing costs, at the same time they could be making a bit of money with their cash in the bank or buying some treasury that would pay them 3% rather than 0 before. So that's very important. Last but not least, I think everyone would understand this, like you do need to have a good management team to run the company, because it's a direction and a strategy that the company is being taken to in the next couple of years, and you want to invest into a company that have a very well-proven management team that have been doing this for a long time. So that is something that we do track and monitor quite closely. You want management team that would have set out certain targets or strategy, and then they continue to deliver to that target and hopefully to beat expectations. And then you feel like you're in good hands, rather than you go into a management team, they make all these big plans to say we're going to do all this, and then 6 to 12 months later they just say, we haven't managed to meet our target, that target has been postponed for another 2 years. I think we have seen a lot of that in the politics in the government in terms of targeting. So we don't want that. So what I've got here is I'm going to kick off in terms of what I've got for today is a blank piece of paper. So we started back in 2017, and we've just celebrated our 5th anniversary in September. And when we first started, we did not have the kind of what do you call it? Like we did not have the hindsight, or we didn't take a top-down view what we're going to invest into. What we did was we spent a lot of time researching on companies, and then we ended up with a few technology companies that we have in the fund. And throughout the 5 years, especially during the pandemic as well, that we have increased our exposure to many of the technology names. So that was one point in 2020 or 21 that some journalists in the UK basically deem us as a tech fund. They always quote like Blue Whale, the tech fund. And we constantly try to refute that idea that we are not a tech fund, we are a global fund, like we can invest in anywhere of the world or sectors. We're not a tech fund, but we just ended up spotting many good investment opportunities in the technology space. So I'll give you some high level take on that. Was we started the fund in 2017. We already had Microsoft, Amazon, Facebook, PayPal, and a few others. But then we didn't have, and then we had Adobe as well. We didn't have some other names such as Autodesk, Viva, and then we have many more software businesses that we ended up having a very big exposure in. And how we then ended up with those names is once we talk about Adobe, which is the transformation in terms of subscription, and we realized that for other companies like Autodesk, which I did share this during one of the MeDirect webinar, I think 2 years ago, that is they do have the same dynamics in terms of the switching costs being very high. At the same time, they give you exposure to different end markets. So Autodesk end clients would be the architect in construction firms. So it's the AutoCAD, if you are familiar with that, is the software that they do. And then they are also exposed to the manufacturing sector, so construction and manufacturing. But what we would not do is it would be difficult for us to invest directly into the construction sector, given that the quality profile of those companies or sectors is very low. And in the UK, we have a company called Balfour Beatty. It's very big in terms of being a constructor. But if you look at the operating margin, it's like 3%. It's very low margin. So when the time is right, when everyone is investing in build roads and building, of course, they would make decent money. But of course, when you have a recession, they would basically lose money because the margin is very low. And it's very cyclical. But for a company that provide the back end, being the software, it's like your Microsoft, it's like your Excel and Outlook, is not only that the margin profile of this software company is very high, that's over like 30% plus, and some of them even like in the range of 40%. At the same time, it's recurring revenue stream that the cash flow profile is very positive and they can roll out the product quite quickly and all that stuff. So to us, like Autodesk, which is similar to Adobe in one aspect that they are a software company or technology, but the end market is completely different, which makes it quite attractive. So we ended up with quite a few of those. But something have changed going forward, that we realized that a lot of this opportunity that we had in the fund is no longer as attractive, which I'm going to go on to later. But then let me just finish on the 2 points that I've got at the bottom is the reason that things are changing is not so much to do with the interest rate and inflation narrative. I think we had quite a lot of that at the beginning of the year. Our belief is that interest rate cycle is cyclical, not structural, which means that at the moment interest rate is going up, it's going to peak at some point, hopefully next year. In the US, it's expected that it could peak at about 5%. And at some point, it's going to come down. Right? If inflation is under control, it might come down. Okay, how far it's going to come down, yet to be seen. It's unlikely that we'll go back to 0% interest rate, but it could come back down to 3 to 4%, which is a lot better than 5 to 6. It's not structural that unless you believe interest rate is going to go up forever, which means every year interest rates just go up by 1 to 2%, then in 3 years' time, interest rate could be at 10%. And we are still functioning as an economy. People still have jobs. Inflation is still not under control, which would be difficult for that to happen. Like if we're paying 10% interest on our mortgage and all that, I think a lot of people would have gone bankrupt, and hence there's less spending going into the economy, and then we have a recession and inflation will be under control. So anyway, the point I'm trying to make is interest rate is not something that we worry about. At the moment, it's not a good time. And hence we have lost money this year, but it's shorter term. I think over the medium term, at some point, interest rate would be lower or it would stabilize. But what we worry about is the fundamental shift in the real world, which is the geopolitics, deglobalization, cost of living crisis, certain recession, which is inflation-led squeeze on consumer spending in our pocket, that we have a lot less money now to spend on discretionary items. Right, we have to be very selective where we're going to spend the money, given a lot of our money are going into energy bills, mortgage repayment, and all that. And at the same time, we also recognize there's going to be some new opportunity on the back of some of the concerns that I outlined there, is there's going to be a lot more reshoring opportunity in terms of industrial activities, which I will touch on a bit later. So before I do this is something to recap what happened in the last few years. So I prepped a presentation about 6 months ago. It's about avoiding growth traps. And the name, you should be familiar with most of these names, what they do, Robinhood, WeWork, Peloton, DocuSign, Ocado in the UK, Zoom, and Bitcoin. I got ARK, which is Cathie Wood's portfolio. You follow Cathie Wood in the US. And these are very low quality businesses. All of this in the circle there. And we would never have considered that. And of course, I'm happy to expand on that if you want to raise a question later on. I won't have time to touch on that. But the names that I've got outside of that circle are the names that we used to invest into, we used to have in the fund, some of them since the beginning. And we have exited all of them. So in Q4 last year, in 2021, that we sold off Amazon. So that was the first company we exited. And then in early this year, at the end of January and early February, we exited both Meta, which is Facebook, and PayPal. I will come back on that if people are interested. And then we started to reduce our position in Google, Alphabet, throughout this year. And then we exited Google completely before the summer. So we no longer have any FANG names in the fund. I mean, we never have held Netflix nor Apple. But then for the FANG names that I've got on here, we have exited them completely. But in the last good 4 years of the fund, our 5, they were very good opportunity. There's a lot of digital transformation going on. There's a lot of things going on. And I use one example to illustrate that what has changed. So Alphabet, Google, people should be familiar with the search, with all this advert, the highest rank, the page, the top ranked advert sponsor ad that we see when we search on some things like YouTube in terms of digital advertising. So 5 years ago, when we started position, in terms of advertising dollars, about 1/3 of those digital advertising dollar is going into digital media spend, which is Google, Facebook, Twitter, anything that's online. The other 2/3 of the advertising dollar is going into traditional media, which is your TV and print and billboards and all this, everything that we're familiar with before the pandemic. And 5 years later, just because of the pandemic, at the same time, that it's been easier for the advertiser to target us because of our data through digital. Hence, the return on investment is much better in digital than TV or print, because you don't know who have read your paper or saw your advert. But in the online world, if you click on something, a lot of data are being captured, and they can see whether it's sensible for them to invest or to continue to bid for those adverts. 5 years later, that split has got reversed. So now 2/3 of the advertising dollar is being spent in digital media. Not 1/3, it's 1/3 to 2/3. And then the traditional media has shrunk from 2/3 to 1/3. So now the split has completely changed. And then the question from now going forward, so obviously Google have had a high return on invested capital profile for the last 5 years, but then it's what's going to happen in the next 5 years. So firstly, if you're worried about a recession in Europe or maybe a slowdown in Asia, which we do, then it means that we have less money to spend. If we have less money to spend on discretionary item, it means that the advertisers are going to spend less money to come after us. Because while we can click on all these adverts, do you want to buy a new bike? Do you want to go on holiday? We click on it. But we're not going to complete the transaction because we don't have too much money like we did during the pandemic when most people were sitting at home getting a paycheck from the government. You can buy whatever you want. So at the time, a lot of advertisers spending a lot of money to target people who got paycheck from the government to buy stuff that are probably not very useful. But going forward, it's a lot more difficult. And at the same time, the transformation, the transition from traditional media to digital is almost completed. Because unless you think the traditional media is going to zero, so that no one watch TV anymore, no one reads any print material, no one see any billboard advertisement, then it's a lot more difficult for the digital advertiser, which is like Google, to grow from here. So they can maintain their market share, but then from 60, let's say 2/3, 65% to get to 70%, it's a lot more difficult for them compared to the time that when they get from 30% to 60%. It's just like they managed to double their exposure in the last 5 years. But in the next 5 years, they're not going to double, because you can't double. Like, you only own 70% of the market. You can't double again. So the level of growth will be a lot slower. So that is Google. And we think that the recession concern for the advertisers that's being spent in digital media is going to be a headwind in the next 5 years. So we have exited Google. So these are the names that we used to own. Google is a good company. But what I'm trying to say is these companies no longer look attractive to us in terms of outperformance profile in the next 5 years. It's a good company. At some point, we'll revisit them, but not today. And what I have got here is just to prep everyone to talk about something quite familiar before I talk about companies that you might not be aware of, to illustrate how we define high quality businesses. So we have both Visa and MasterCard as our top 10 holdings in the fund. You would see that. We have a short description. And how we think about why there's high quality is, people should know this, is they are duopoly. So they basically, it's a two players market. It's either your bank partner with Visa or your bank partner with MasterCard, or a bit of both, depending on credit card or debit card. And then if you look at Visa, they are present in over 90 million merchants worldwide. That is a lot. It's not easy to replicate that effort. Like if you contrast MasterCard and Visa versus American Express, I mean, you would know that unless you go to the US, you can use your Amex. In Europe, sometimes it's quite difficult. If you go to Asia, it's a bit mixed depending on which country you go into. But MasterCard and Visa is mostly accepted worldwide. So that competitive position is very entrenched. And then the second point I put on here is about disruption. So at the moment, we cannot see any disruptors coming into market. I think if you follow the industry, there has been a few suspects that try to disrupt the network, like the buy now, pay later 2 years ago. We never felt like it's going to disrupt them. Actually, a lot of banks now are rolling out buy now, pay later, partnering with Visa and MasterCard. The biggest disruptor that we have identified, the biggest disruptor that we have identified in the last few years, that's no longer a disruptor for many years to come, is crypto. So if you follow crypto or Bitcoin or Ethereum or Ether, different things that's going on, a lot of mass going on, that is the only thing that we think could become a disruptor. What do we mean by that? Is, let's imagine if in 10 years time, it could be 20, it could be 100 years, that the newer generation decided to make their transaction through Bitcoin network. So they want to buy a car, they want to go to Amazon, and if Amazon accept Bitcoin or Tesla already said for a short period of time they're going to accept Bitcoin to buy the Tesla car, then it means that less volume is going to go through the MasterCard and Visa network. So that is a threat, because it's a closed loop system that there's a lot of things that can go on, like the NFT and all that. It's not going through MasterCard and Visa, it's going through the crypto network. Unfortunately, this year or last year, that it seems like it's no longer a threat for a long, long time, right? At some point, it's going to come back. I would not write that off. It's going to be in a different form of whatever we have had in the last few years. It's going to be different. But then that would be the biggest threat if you want to identify something. But it's not happened yet. And at the same time, as I outlined at the beginning, is because we spend so much time researching or covering our company, is we continue to track the developments of what's going on, and hopefully we will be able to identify the threat sooner if it does materialize. At the moment, that's no threat, but of course, would not become a threat. So we continue to track that. And then the other thing that I outline here is the transition from cash to contactless, and also contactless to online to mobile is still happening. So in the UK, that we have most of people would have got some sort of contactless card. But then in the US, if you follow the US market, for some reason they are quite late adopter to contactless payment. It's only over the last 2 years that a lot of banks have issued contactless card. So 2 years before then, like contactless basically didn't happen in the US. And so that is going to make more money for Mastercard and Visa in the next few years in the US because they're big in the US, obviously. The last point I would make on here is why I said they're good inflation hedge or beneficiary on the back of high inflation is because they make money on the back of our nominal spend. So if you take out your card, either debit card or credit card, doesn't matter. You go to a restaurant, suddenly you realize that the prices has gone up by 10%, or your service charge has gone up, or you book a holiday, your flight ticket has gone up 10%, then they make 10% more. So they take a cut on the nominal spend of our money. So inflation is good for that because even though that we might be spending less, but then the money that we spend is more in the nominal context. And last but not least is because the network in itself is heavily powered by technology. Can you imagine these two companies combining? I mean, the market cap on your sheet there should say about maybe 400 to 500 billion worth, and it's only two network company. There's only 50,000 people globally, only 50,000 people, and they're doing everything that we need. So hence their cost base are not going up as much. They don't need to expand to different warehouses. They don't need to pay kind of the lower wage workers to do the delivery. Like we don't want that, and it's heavily powered by technology. So what it means is they could be making more money because their cost base is not going up. Like it's just the same network that they could power much more transactions. So strong balance sheet, very high gross margin because most of that is in-house development and systems, and then hence they do generate very high return on invested capital. And Mastercard and Visa in itself is one of those highest operating margin business in the world. It's in the range of 50% operating margin. And the free cash flow is very attractive. So this is just to kick off, so make sure everyone is on the same page. And then the next three set of opportunities you might be aware of or not be aware of. This is something more specific to us. And the few things that we have done, if you remember the previous slide that I've outlined about the geopolitics, about reshoring opportunities, and there are a few sectors that would benefit on the back of that. So one is semiconductors. So I think this year has not been a good year. Our funds suffer on the back of the reset in earnings and valuation of some of our semiconductors companies such as ASML and Lam Research. So they sell equipment to the foundry. But if you look at a chart, which is a bit small to see, is because of the geopolitics uncertainty in Asia. Everyone would have followed what's going on in China and Taiwan and all this stuff. Then from the Western perspective, that we want to have silicon sovereignty. We want to have more of this foundry built and operate out of Europe and the US. We want to be able to produce the chips in time, not going to be 100% dependent on Taiwan like before, or including Samsung in Korea. That we want to do that. And if you look at this chart here, there's some numbers. I mean, we are talking about 300 billion of investment that's going to come into a lot of foundry in the US and in Europe. And if you are selling the equipment to go into those foundry, which is ASML and Lam Research, it basically means that you are selling a lot more equipment going forward because those production capability in Taiwan is going to be replicated in the Western world. So this is a very straightforward reshoring opportunity if you're looking at something that is actually selling more. Unfortunately, this year that the shares has been hit by the earnings downgrade on the back of that we have bought less PCs, smartphones, and they are still exposed to the more cyclical element. But what we think is going to happen in the next couple of years is the cyclicality of these businesses would be much lower, just because what has been outlined here, that it takes 1 to 2 years or a couple of years before those foundry would order the product. So typically it takes about 5 years to build a foundry. So if you follow the CHIPS Act in the US, Intel saying we're going to build this foundry, it would take them 5 years. And by the time you order the product from ASML or Lam Research, it will be probably 1 to 2 years before you open your foundry. So you're not going to place an order now. So that journey has just started. So we would expect more product to be sold in the Western world. The other one is something fairly new to us that we have introduced this year is the US railroads. So we have never invested in the railroads before, but this year we have identified that there's going to be a lot more reshoring or reintegration of industrial activities. But of course, when people talk about reshoring opportunities, it's not a fancy term. It's not everywhere. It's not reshore everywhere, right? Like if you think about what's going on in Asia Pacific, there's certain reshoring opportunities in India and Vietnam away from China. But we would expect that the reshoring or manufacturing capability production in Asia Pac in the next 5 years is going to be smaller compared to the last 5 years, just because of the geopolitics uncertainty. Everyone would know, sitting here in Europe, that no one is reshoring back to Europe because of energy crisis. Like if you follow some of the big company in Germany, they're actually thinking about reshoring away from Germany. If you're selling product to the US, you want to be based in the US. So this reshoring opportunity is very specific if you have to pick a region, and we have identified that North America is the region. If you're a global company, you're selling a lot to US consumer, it makes sense that you produce your product locally. If you're an American company selling product domestically, it makes sense that you do that locally. And what I've got here is Make America Great Again. Why I've got that there was the journey actually started, the narrative started when Trump was elected. I mean, that was his slogan, to make America great again. What it meant at the time was to create a lot of jobs locally, to get businesses to bring their production back to the US so that they can create jobs to make US competitive. Of course, no one listened to it. It's a great slogan. I'm not sure how many jobs he has created, probably not a lot. And then since then, we have the pandemic. And a lot of goods used to be produced in Asia. And of course, we then learned that the supply chain is quite vulnerable on the back of a pandemic, that different countries have different policy, and suddenly you have this shutdown in certain part of Asia Pac, and then the shipping route get disrupted, and then we never get the goods that we've got or we've ordered from a company perspective or from our perspective. And that was a big narrative then to say, okay, we need to have more of this produced locally. Now pandemic is almost over. No one cares about that. And of course, that period of time, there's a lot of uncertainty. So no one would have done too much. I mean, you just want to make sure your company will survive during the pandemic before you think about, I'm going to reinvest back into the Western world. But what have changed this year is about the geopolitics in Russia, in Asia, that now it does make sense. There's no more pandemic. If you think about what you're going to do as a company in the next couple of years, it does make sense that you want to reshore now. So everything got started when Trump was elected, but the journey have just kicked off. And so the railroads that we have got is two companies called Canadian National and Union Pacific. It's basically linking Canada to the West Coast and also the West Coast to Mexico. And if you think about Mexico being quite in proximity to the US, it makes sense that some of the stuff should be going to Mexico. And if you invest into the rails, then a lot of things would need to get transported. So at the moment, Canadian National is doing particularly well because a lot of the commodities and food products are being transported from Canada to the US, just because we're having a bit of supply issues in the US. So that is that. And for these two sectors, they do have very strong competitive position in their own right. They're market leader in their own perspective. And then for the railroads, they are literally monopoly. So if you need to go through that network, like you have to go through them. There's no competitors. You can't start up another rail route, whatever, for the next few hundred years. It's just all set. So they're good businesses. This might be a bit new, so this is something that we do, that we are not purely a tech fund, is we also invest into medical equipment companies. So I call it medical technology, but they're medical equipment companies. So we do see certain growth opportunity within the medical space. And the two companies that I have got here, which is on your sheets as well as our top 10, one is called Dexcom. So Dexcom is, they basically provide device for to monitor your glucose level in your body. So if you have diabetes or you're at risk having a diabetes, they basically have a sensor that you can put onto your arm or your body, and then you can track your glucose level in your body real time. So typically, this would have been used by people with serious diabetes kind of phenomenon that in the US would be the type 1, and then you get subsidies by the government or the healthcare sector. But what have changed recently is there's so many people in the developed market, just because I think our diet has become a lot better, that if you look at the chart there, that you can see that we are going to have many more people to have some sort of diabetes syndrome. That if we're not careful, that this could become a massive burden to the developed market or to the government, to the healthcare sector. And in the US recently, what Medicare have done is to expand the coverage in terms of how, if you have not the type 1, but you have your type 2, but you have you're more severe type 2 rather than just pure type 2, that you can now get funding from the insurance company to give you the Dexcom device. And of course, if everyone has some sort of Dexcom device, then it's unlikely that we will endanger ourselves into the type 1, which is an incurable kind of issues. And then the other one is Sartorius, which is a very different medical equipment company, is they go into biologics. So I wouldn't explain what all this science behind the scene means, but if you follow all these COVID-related drugs, 90% of that would be produced using biologics versus chemical processes that most other drugs are being produced. And of course, the reason that we got our COVID vaccine so quickly is exactly because of the process. It's based on biologics. It's more expensive, it's more efficient, it does work better. And in today's world, only about 30% of the drugs being sold is done on biologics. We would expect this journey to continue, and in the next 5 to 10 years, that number should get to about 60 to probably 60% at least, that the drugs would be produced by biologics, which is similar to the argument that I made earlier about the advertising dollar being spent in digital media versus traditional. We would think the biologics would take a bigger portion of the drugs development versus chemical processor. It might take more than 5 years, because it's a bit slower burning the sector, but that we will get there. So if you are the company who are selling the key product, which is part of the process, the equipment in this lab here, then you're going to benefit a lot in the next 5 years. So you're going to sell more products in the next 5 years. The last company I have prepared for you is, some people might be familiar with this, is my favorite company. Is called NVIDIA. So NVIDIA has historically been known as, in the gaming world, if you mine crypto, that the GPU would have been used in the crypto mining machine. If you play games, you're a very sophisticated gamer, it would be in your PC. But what is going to happen in the next couple of years, which the journey already started in the last few years, is that there's structural growth opportunity in artificial intelligence in terms of automation, robotics, analysis, real-time recommendations. And let me give you one example that you will be familiar with. Back in the old days, all our data are stored locally, right? We didn't have smartphone, we didn't send all our data to the cloud. All our data would be stored locally on your PC. If you have browsed certain pages, you've done something, it's stored on your PC. But over the last 5 years, we have generated a lot of data to the internet, like basically a lot of data. I mean, you will be scared to find out like how much of our data actually on the cloud, depending on what services that you have used. And of course, once you have all this data, that those data would only be valuable if they are being analyzed and utilized. And one way of doing this is, if you go onto YouTube or any other streaming, that you would have seen a video, maybe a 2-minute video, and then as soon as you finish it, you will see a recommendation. Oh, you might want to see this too, like the different things. And these kind of recommendations are not being done just based on your profile. It's not been done before you watch the video. These kind of recommendations are being done real time. It's like as soon as you click, your data gets sent, being processed in the cloud, and then they come up with all this algorithm looking at other people who have watched this video, which other video they might want to see after this, is then the recommendation being made to you individually, real time. And who is processing all this? is NVIDIA's GPU in the cloud, not on your PC, it's in the cloud. And you'll be talking about, we have about 2 billion smartphone users or people who have some sort of access to internet worldwide. And these kind of recommendation is not done on profiling. So it's not like the demographics, the age group, or whether you're female or male, or where you are based or live. It's about you specifically. So easily, if you look at how many apps you have got on your phone or how many services that you do online, you'll be talking about many multiples of billions of individualized recommendation systems. So let's say YouTube, 2 billion people use YouTube. This recommendation is being done for 2 billion times, continuously, depending on how much video you consume. If you go to Amazon, you want to buy something, they want to recommend the next product for you to buy, there's another few hundred million or billions of users. If you go onto Instagram, you click on something, they want to recommend something to you, that's another billions of users. You go on to different things, there's so many things, and you need that to be power and utilized, and NVIDIA's GPU is very suitable to do that. And it's been proven that they've done that. And so I've outlined a few other sectors which I would not have time to touch on. It's like if you look at the sectors that NVIDIA is involved, it's not just about technology, it's about industrial, about like DNA sequencing. If you need to analyze certain sequencing, you need to have the computing power to do that. And it does go into many different industries. And obviously it does have very strong financials, return on invested capital profile, and strong balance sheet. Is still led by the founder, so the management team is exceptional. And what I've got at the bottom is I do personally believe that if I have to pick one company to become the next $1 trillion company, NVIDIA could be one. This year has not done well, so the shares is down quite a lot. It's down about 40%. The market cap is about $400 billion. But then in the next couple of years, we think the products that NVIDIA is going to sell, or to capture our imagination, to automate or digitize the different parts of the economy, is going to be very significant. So the money the revenue they're going to generate in the next 5 to 10 years is going to be a lot. So I would personally think it could become the next $1 trillion company. So this is just a slide that I prepped on the outlook. So I hope that I have given you a bit of flavor about how we define high quality businesses, and this is just a bit of outlook that I already outlined, that we are not so much worried about interest rate. I think now the narrative is totally about recession, that in the UK already we are in a recession, in the US it's probably going to be in a recession sometime next year. And the thing about recession is we do believe that recession is deflationary, it's not inflationary. When people start to lose their job, when we have higher level unemployment, when companies stop hiring or pay people less, and then the housing market reset. We haven't talked about the housing market bubbles, that is going to be a bit lower next coming years compared to before. That it would just have negative wealth effect, which is basically deflationary. And then the point I've got at the bottom, which is very important, is in that sort of scenario, is you want to invest into a company or hold onto a company that have very strong balance sheet that I already talked about, that would continue to do well, higher operating margin that's not being impacted by inflation or interest rate going up. They are asset light, that their gross margin are pretty high. They still have structural growth drivers. They can still do well. So maybe they didn't do well this year, NVIDIA didn't do well this year, but in the next few years they will do fairly well, just because we do need their product. And then last but not least is the valuation is attractive given the earnings growth trajectory. You continue to think they're going to make more money in the next coming years because they're selling more products. And then what I've got on the other side, which is just a chart to show that we're now in the bottom left part, which we think the fundamentals of our company, using earnings revision as a proxy, is still very strong. But then the share price is down. So we're down about 25% this year. But then it makes it quite attractive. So the last slide I've got here is just to recap that our investment approach is to find high quality businesses at an attractive valuation, spend a lot of time researching on those companies, doing financial modeling, making forecasts, tracking them, And then when we first started, we had a lot of technology names in the fund. Now we have less of that. We are being very selective, so we still have a few that are outlined here. But then we spotted new opportunities, which I talk about. We haven't talked about Charles Schwab, but we had that last year that's going to benefit on high interest rate environment. We added railroads early this year, and then we started going into energy. So that's certain new pocket of opportunity, not the main fund, but then I think they are going to be quite beneficial to the fund. And last but not least is our hurdle in terms of how good this company are is remain unchanged, even though that we are going into different sectors. We are still wearing the same lens when we look at a company to analyze the valuation, to analyze the competitive landscape. Hopefully you have now know how we do that. And that is how we hope that in the next 5 years we are going to do equally well as the first 4 years. And this year has been a bit challenging, but we are quite confident the portfolio is well positioned for the next coming years. So I will stop here.
Over the few hours, we received a number of questions from yourselves, and now I invite Edward Malia, who will be moderating a Q&A session together with Stephen. It should not take more than 10 minutes. So, Edward?
Thank you very much, Ingrid and MeDirect. I hope you all enjoyed that presentation. There's a few questions we've received, some of which have already been covered by Stephen. But I'll start with the first one, which, as you can imagine, has a lot to do with inflation and your predictions and expectations. So how bad inflation can get and where interest rates may go over the next year or so.
Yes, I think the first thing I would say is I think inflation is the easy one to manage, because at the moment, if you look at the data in the US or in Europe, that we already are seeing much lower level of inflation on a month-on-month basis. So the headline that people quote, or all these newspapers like to quote, is that we are still having 10% inflation. But of course, that 10% is comparing to this time last year is not the 10% you're paying. If you look at a month-on-month inflation in Europe, is already negative. That this month compared to the last month, that is already lower. Okay, whether that is going to continue, hopefully yes, maybe not. But inflation is a function of a demand pool kind of in terms of what happened during the pandemic. There's a lot of free money being printed, and suddenly people didn't go on holiday for 2 years, and everyone is competing for the next holidays. But what we do know is this time next year, most of us will feel a lot poorer compared to the last 2 years. And we are going to be very selective in terms of where we're going to spend the money. So inflation, we do think is going to be a lot lower. I mean, if you ask me to put a number, it will be less than 5% next year. I mean, even if you look at the energy prices and commodity prices, it's already unchanged or slightly negative compared to a year ago. So whatever, Europe is a special case, but then if you're not in Europe, then you will be paying a lower energy bill next year compared to the first 6 months of this year, for example. The last thing about interest rate is difficult, because obviously the central bank in the US is trying to do what they think is right, is to tackle inflation. What is slightly confusing is the level of interest rate does take a bit of time to feed into the economy. So if you have a mortgage, you need to refinance. It's not real time. The interest rate has been going up, but it's not real time. It's going to hit you in your pocket. If you got the house 18 months ago and then you have a 2-year mortgage, then only 6 months later, next year, at some point during the summer, it would hit you. So one thing that is slightly confusing is, of course, from a central banker's perspective, you want to raise interest rate to make sure inflation is under control. But at the same time, you need to acknowledge that it comes with a lag to the real economy. So we would think next year the inflation will be a lot lower, and hopefully the central bankers will recognize that the interest rate could peak at the level that's being expected. So in the US, it's about 5%.
Thank you, Stephen. And I think probably a question on many people's mind, but we've been asked how you would recommend to investors to approach the market in these volatile times. How should they approach their investments given the volatility that we've seen this year? This
is a very good question. This is something that's very close to heart. So from the fund perspective, that's a limitation of what we can do. We are mostly fully invested. We only have about 5% cash in the fund as we speak. And we take a medium-term view in terms of the time investment horizon, about 5 years, when we invest into a company. But from a personal basis, that I think it's important that people don't forget that the best opportunity comes when the market is very uncertain, rather than when everyone is making money, everyone is feeling very happy about that market. It's so easy. We talk about some of the growth traps before. That was an easy time. Like, we were avoiding them. But if you have got some of those names, you would have done even better during the pandemic period. They would have gone up maybe 100%, 200%, but now they have probably lost 90% this year. So it's important that you put your money into good assets, that you invest into good company. And one thing that we have done in the UK is, because we do have quite a few retail followers into the UK fund, not the offshore fund here, is the company Whale Capital decided to invest some money into the fund. So we decided to invest in about £120,000 into the fund. But the way that we've done it is, instead of doing it lump sum, which is you invest in one go, and then the market's very volatile, then 3 months later you realize that you lost 10%, and you look a bit silly, and people will say, like, you just made this up and it's a chaos. We decided that I think a sensible strategy is do it over the course of a year. So we did it through a pound cost averaging exercise. So we do 10K a month at the beginning of every month, and then we started that journey in August this year, and then we have just put in about 50,000 out of the 120. And then now the prices that we have got is, some prices were a bit higher, some prices were a bit lower, and now we have just about break even in terms of the real prices. And I personally believe that in the next 6 to 12 months that we are going to see the bottom. At the moment, it's very difficult. We don't know what the bottom looks like. Is it going to be lower? Is it going to be the same level as where we are? But then we think we're likely to see that. And the other thing, which is something people shouldn't miss, is, of course, the market is, depending on which market you're looking at, is down about 20 to 25% this year. It might take 2 years for the market to recover to the peak, which is what many commentators would quote. The market only recover back to its peak in 2024, 2025, and so do nothing in the meantime. That is the wrong approach, because when you look at the market, it's down, but then when it recovers, if you can start putting money in, or you haven't taken any money out, then you could break even sooner if you have invested in the wrong time last year. And at the same time, you could be making money sooner before the market get back to the peak. I think the worst thing for individual to do is to time the market. It's very difficult to time the market. I mean, you can ask me all the different things that I've learned over my 20 years of career. You can time it right, maybe one time. If you can, it's impossible to do it consistently. And I think it's right to be cautious, but at the same time, don't miss out the opportunity that you probably want to do a little bit every couple of weeks or months, and just feel your way through that. And hopefully over the medium term, that should serve you right, because if you invest more money into good assets, not bad asset, I mean, don't put money into crypto, for example, that you might not get it back.
Thank you, Stephen. And just because in the interest of time, I'll ask you one last question. And we've been asked about how we how we construct the portfolio, and we're called the growth fund, but will we at times consider going into lower valued companies or dividend paying companies? How would we construct the portfolio, and how would we manage cash, especially in times which have been a bit more difficult?
So the quality profile of the company that we invest into is the most important. So we would not lower the bar. Things that we didn't invest into before, we would not consider that now. And so that would not change. It's very important. And then secondly, in terms of the portfolio construction of our cash, it's always about the opportunity set. There's a limitation, I think, in the reality sense that this is a long-only fund. Of course, we could raise a lot of cash, but if the market is down, that we will still lose money. It's impossible for us to make money, even though that we have high level of cash, because everything else would have gone down in value. So the cash position itself, we try not to time the market. At the peak this year, we had about 10% cash, just because we were making transition to sell out from certain holdings, going into new ideas. And at the moment, we have got some new ideas in the fund, and then we are now running about 5% cash. And in the next couple of months, if we continue to build our conviction in the new holdings that we have in the fund, then we'll have a bit lower cash. So I think timing the market is difficult that it's always impossible to get back, because by the time you say, oh, the market has bottomed, like the market will be a bit higher rather than you have literally spotted the bottom, which is the difficult one. So
Perfect. Thank you very much, Stephen.
So, Stephen, Edward, thank you very much for your time today. I'm sure we all found it very, very interesting. A big thank you goes also to all of you who have joined us today. For those of you present with us here today, we invite you now to step to the next room so that we can all share some drinks. Stephen, Edward, and our teams of advisors will all be present, so if you have any other further questions, we will be very happy to answer them. Thank you once again, and nice evening, everyone.